Hi everyone, welcome to today's video. So according to Mr. Ray Dalio, there are 6 specific signs that an empire is in a state of decline. He has discussed this entire framework in his book called as The Changing World Order. Very quickly recapping, our empire declines when 6 things start happening. Number 1, the interest rate falls to absolute zero. Second, there will be a lot of money printing or debt printing. Third, there will be some kind of financial crisis. As a result, there will be increasing wage gap and income inequality. Finally, there will be some kind of internal disorder and external disorder. Now, if you pause and reflect on these 6 points, you will quickly realize that something similar is happening in the economy, and the economy is getting fundamentally weaker. For example, consider the scenario of interest rate. You will quickly see that back in 2008, after the 2008 crisis, the interest rate were cut down to zero and they stayed close to zero for almost 7-8 years. So this meets step 1. Almost 20% of the money in circulation in the US has been printed after 2020. So this justifies the point that a lot of money or a lot of crazy money printing has happened after the year 2020. It started much before, but after 2020, it really skyrocketed. If you consider the last 1.5 decades, one could argue that there have been 3 major crises. One was 2008 crisis, one was 2020 crisis, and one was 2021 or start of 2022 crisis, where the markets have definitely corrected by 15-20%. If you talk about the wealth gap, so here is the data and decade-wise data of the wealth gap that is happening. Now finally, if we speak about internal and external conflicts, there is no specific data that we can measure, but you can apply a little bit of brain and common sense there. Go on Twitter, go on LinkedIn, go on any social media platform, you will see people just fighting with each other all day long. Even in the comment section, there will be a lot of people, they will keep on fighting. So to cut the long story short, it is very clear that the economy fundamentally, not only in India, but all across the globe is weakening. Again, I will get a lot of rebuttals. So here is the chart for India's GDP growth. And India has been one of the shining or bright stars in the world economy that is growing. And you can also see that our GDP is flatlining in real terms. What is the meaning of real terms? You will understand subsequently on the video. So to cut the long story short, the world GDP is actually stagnating. Now, does that mean that the stock market is going to rise, fall? What is going to happen there? Because Akshat, you are bullish about the stock market, but you seem to be bearish about the economy. So what is happening? No. So economy and stock market works very, very differently. And again, I'll help you understand the video, but there are 3 central points or 3 critical points that you need to understand. One is that why is it that the world is suffering right now when it comes to growth? Second key point, that if the economy is genuinely flatlining, then what will be the impact on the stock market? Third and finally, is there something that you can do as an investor in order to protect yourself? So I will break apart this extremely complicated macroeconomic analysis in simple words. Even if you're from a science background and you have not had any experience of studying economics, you will understand these points. My mission is that you understand economics fundamentally, you question the data, you start looking at the right data and use your own brain to form your own judgments. If you like this philosophy, do press the like button. It would allow these type of videos to reach out to more people. We live in an era where economic data is hyper manipulated. People just go by general impressions. This is happening more and more as we are approaching the election years. I am not trying to sway you in one particular direction. I am just simply teaching you how to pick up data, how to analyze data, and how to interpret data. What you choose to do with this, that is completely your responsibility, but please support these type of independent verified analysis. So let us kickstart, and the first key question that I will help you understand is that why is it that the economies all across the globe are suffering? First, let me take you to the commentary of the World Bank president, and this is what he said, that emerging and developing countries are facing a multi-year period of slow growth driven by heavy debt burdens and weak investment as the global capital is absorbed by advanced economies. Now, problem that happens in these type of commentary is that people don't understand such dense macroeconomic terms and they just get lost and they feel yeah कि क्या ही फर्क पड़ता है, होता रहता है, and these type of commentary it is always given, कुछ होता जाता तो है नहीं, so why should we even bother? Now we have become so immune to these type of commentaries that we don't even bother using our brain to understanding these. So for this, you need to go to the basic definition of growth. Now, when I ask you that what is the meaning of growth, what is it that you will tell me? You will say, yeah, GDP के number आते हैं and people talk about GDP. So that is probably what the meaning of growth is. You're not incorrect. You are completely correct here, but you have to understand this point further. So for example, if you say that growth is equivalent to GDP, then what exactly is GDP? So GDP is the total sum or value of the goods and services that are produced within an economy. Again, this is an economic definition. Boil it down to practical narrative. So what is the practical narrative? For example, let's assume that in the entire world, there are only cars which are produced. Now, how will more cars be produced in the economy? Well, first and foremost, there could be more number of people that might be involved in the production of car. So usually, if more people are involved in production of the car, then the entire world's GDP is likely to go up. Why? Because the quantity or number of people involved in terms of car production goes up. The second equation is the price equation. Then let's assume that there are only 10 cars that were being produced at, let's say, 1000 rupees. Then what is the total GDP? The total GDP become 10,000 rupees. But if you can increase the price of the car, then the GDP also goes up. Now see, price is a very tricky concept, and let me not go into the nitty-gritties of the economy, but let me speak more about the Q part. So basically, to cut the long story short, what is it that I'm getting at? That if you consider the GDP, then it is a function of price times the quantity that is produced. And this Q factor is something that we talk very less about. Now, what is Q? Q is the total quantity of the goods and services that are being produced in the economy. Now, what does this Q depend on? It depends on the number of people times the tech. For example, pick the case study of Instagram. Now, because Instagram is a tech-oriented company, there were a team of 8-10 people who built Instagram and were operating Instagram, and it got acquired at a $1 billion valuation, which is a fairly big valuation. Why? Because the tech there was advanced. So in summary, what is it that I'm trying to tell you is that the GDP growth or the real GDP growth of the world literally depends on population growth. That's A. And more importantly, it depends on the technology innovation that is happening across the globe. Now, if you pause for a second and think about key are big levers of technology innovation, when has that exactly happened? So when is it that the world started producing more and more? Because of technology innovation. So I would say that back in 1500, 1600, the humans moved from walking on the land, riding horses, riding bullock carts to shipbuilding. So that was in the era 1500 to 1600. Then by 1800, 1900s, there was railroads, then came automobiles. So these were major levers of innovation that propelled the world forward. Now go back around 60, 70 years back, what have been the primary innovation that has happened across the globe? Well, the primary innovation has been internet. Now when was internet discovered? Probably like 1980s. Then it got massively adopted by around 2000. But after 2000, can you point to one major lever of innovation? I am speaking about mega innovation. Mega innovation would mean कि आप horse cart से चल के railways पे आ गए. That's a mega innovation. But just you're riding a train at 150, then you suddenly start a bullet train and you start going at 1000. That is not mega innovation. That is simply an improvement. Now, why am I telling you this entire story? Well, to prove the point that the real productivity in the world hasn't gone up much. You can take a look at this chart, and this portrays the entire picture that the real productivity in the world has been falling, and this is a sign of a deep worry. But now you will point out and say that, you know what, Akshat, I see like GDP growth, because India keeps on speaking about the fact that our GDP is growing at like 8-10%. The developed economies keep speaking about the fact that our GDP is growing like 4-5% or whatever. So to cut the long story short, the world is growing because I see the GDP numbers growing. So let's quickly discuss that how is it that the real productivity in the world is not growing at a massive pace, because theoretically speaking, if the GDP in the world was growing at 7-8% genuinely, then the productivity growth across the world would also have been somewhere around that range. But that is not the case. So what exactly is driving the world's GDP? So for this, let me ask you a very interesting question. These days, politicians keep on fighting with each other. You know what, India ki GDP will become like $10 trillion in another 20 years. Some say that no, it will be only $6 trillion. Some says, it will be $50 trillion or whatever. Okay, so let's assume that if India's GDP has to hit $10 trillion. What is the easiest way of making that happen? Some of you say कि bridge बनाने पड़ेंगे वगैरह all this stuff, infrastructure needs to be there, or 50 Adani type companies need to be there. Okay, no. The easiest thing or easiest way to increase our GDP to $10 trillion is print $10 trillion of money. Your GDP will automatically become $10 trillion in notional terms. Notional term means stated terms. It does not mean that really our GDP has become $10 trillion. It's a topic for another day where I will discuss the difference between real GDP and nominal GDP. But for now, you need to understand this basic math that by GDP, if you have to go to $10 trillion, you can print a $10 trillion and the world GDP will also improve. India's GDP will also improve, etc. etc. So something similar has happened in the economy from the year 1970 onwards. Now, why am I saying 1970? Because up until 1970, we were on and off the fiat money and the bimetallic standard, which was the gold and silver standard. But after 1970, the US took the decision of moving away from the gold backed money all the way to paper money. Now, infinite amount of paper money can be printed. So back to Mr. Ray Dalio's framework, and this brings us to the excessive debt printing part. So in simple terms, in order to grow our economies, the world started to take more and more and more debt. Now, what exactly is debt and how does it pan out? For this, you need to understand macroeconomics a little bit. So this section will be a little bit complicated, but let me see if I can simplify it further. So the way debt works is very, very simple. When we say that there is $100 or 100 rupees in the economy, almost 95 rupees does not really exist. It exists in the form of accounting entry in the form of debt. So when we say that there are 100 rupees in the economy, we imagine that, there will be like a 100 rupee note and someone will be holding it. But no, it doesn't work like this. Basically, 95% of the money is almost like digital accounting entry, which will be there on the computer node. And what ends up happening there is that acts as a representation of debt. So let me simplify it further. So let's say that you have 100 rupees. So you go and deposit that in HDFC Bank or ICICI Bank. What does this 100 rupee indicate for the bank? So this 100 rupee for the bank will indicate a liability. The moment HDFC Bank or ICICI Bank take your 100 rupee, it becomes a liability for them. Why is it a liability? Because subsequently they will have to return that 100 rupee. So in order to give that 100 rupee back plus interest, what is it that HDFC Bank will have to do? Well, it will have to do something called as reinvest that money. And this reinvestment happens in what way? Well, the banks typically give out loans. For them, this loan becomes an asset, and this loan is supposed to be invested in real assets. For example, there could be businesses that would be built out of it, or some real estate, or some gold, or some kind of financial asset. So here what happens is that HDFC Bank will invest this money in T-bill and it will get some part of the money back. But at the back end, even these T-bills are supposed to be investing in something called as real assets. For example, bridges will be built or ports will be built, vagera, vagera. So that is how exact mechanism needs to be played out. Now, unfortunately, with the creation of excess debt, that every time more and more money is printed, what ends up happening to these assets? Well, some real assets like this would go up in value because you can't print more roads, more bridges, more commodities, etc. But on the flip side, these financial assets lose their value in a way. And that is precisely what happened with Silicon Valley Bank crisis. That Silicon Valley Bank had invested a lot of their consumer or customer deposit in T-bills, which are supposed to be the world's safest financial instruments or financial assets. But the notional value of those T-bills came down. Why? Because more money was printed, it devalued these financial assets. The customer got to know, customer felt that, इनको तो bond का loss हो रहा है. They had put their money in some dud instrument called as T-bill. But T-bills are AAA rating bonds, but their notional value came down. So as a result, people started demanding their money back and the bank had nowhere to go. So this brings us to a very interesting statement that Mr. Warren Buffett recently issued. So I will play the clip and I will then give you my commentary.
Are we through the banking crisis at this point?
We're not through with bank failures. The owners of banks may have lost a hell of a lot of money. The people who bought the debt of the holding company, they may lose a lot of money. People can lose a lot of money, but the depositors aren't. And so you don't need to turn a dumb decision by managers into panicking the whole citizenry of the United States about something they don't need to be panicked about.
So he said something very interesting. He said that, the owners of banks like SVB will lose in this entire game, but the depositors are customers like you and me, we will not lose our money. So theoretically, Mr. Warren Buffett is right, but he has only explained you half the equation. So let me explain you the complete equation. So basically what happens is that whenever banks like Silicon Valley Bank or Credit Suisse or Yes Bank in India, they go under the governments or the central government or Reserve Bank of India or any government organization, they will do some kind of recapitalization of the bank, or they will find some other alternate buyers. But where does that organization gets money from? Well, it is through debt creation, or more money or debt is created into the economy. So who ends up paying for that debt? Well, you pay it. Not directly, that your taxes end up going higher, and higher inflation. Inflation means price rise. So yes, you are getting your money back that you had put in 100 rupees, and you will eventually get that 100 rupee back. Even if you are a depositor in Yes Bank, you have gotten your 100 rupee back. But the entire populace or entire population ends up paying higher taxes because that bailout money, let's assume that 1000 crore or 10,000 crore were put in to save Yes Bank. That 10,000 crore of Vasuli needs to be done through increasing taxation or through higher inflation. And that is precisely what the problem has been. Now, just to complete the thought, who benefits through crises like this? It is exactly people like Mr. Warren Buffett, who are extremely rich, who ends up buying these type of banks at discounted prices and are then called legendary investors. To cut the long story short, this is the roadmap as to why rich people keep on getting richer, because they have more access to debt, while the common people end up paying a higher proportion of their income in the form of taxes. Now the thing is that up until this point, this bailout model was serving the rich really, really well. People like Mr. Warren Buffett were getting richer and richer, and they were making these type of statements. People were not understanding half the side of the equation. But now people have started to realize economics slightly better, and second, they are actually gasping for air. Now many of you might be living in a fool's paradise that you will say that, you know what, you're wrong, that there is no price rise that is happening. Prices have gone up by almost 20-30% in the last 2 years for every single thing. You name it, almost 90-95% of the things that you use on everyday basis, prices of that would have at least gone up by 20-30% over the last 2 to 3 years. Why is that? Because the fissures in the economy are now erupting. This bailout model is not working out anymore. So you might have a natural response कि ऐसा क्योंकि bailout model is not working. Well, there are multiple reasons, but let me outline 3 most important. So first is that you can't create debt too fast. The world can keep on taking more and more debt with time. No one can deny that, since we are on that fiat money system where you can print infinite amount of money, infinite amount of debt can be taken. But at what pace? That is the problem, because one major round of quantitative easing, which is printing of money and giving it in the economy, has already been done in 2008. That was a model. Then again in 2020, 2021. So bunch of instances have happened over the last 1.5 decades, and that has made the economy fundamentally weaker. Second key point is that you can't rescue poor financial institutes over and over and over again. There will be a breakage point that you will hit, and it seems like that we are hitting that breakage point. Why am I saying it? Because again, go back to that Credit Suisse story. It's very, very simple. It was one of the biggest financial institutes in the world, and look at the fate that it is suffering now. Third and final reason is that you can't generate too much of fake growth beyond a point. Up until 1970, mostly the type of growth that we have seen in the world, it was slow growth, but it was sustainable growth. After 1970, up until now, almost 60 years, we have seen a lot of fake growth. And now the chickens have come to roost. And if the governments and central banks do not clean up their act, all this will reflect in the form of higher inflation all across the globe, which is already happening. So what happens next? So here's a very famous economist. He gives a little bit of pessimistic commentary, but he has given very sensible view on this. His name is Dr. Rubini. He is also called as Dr. Doom. So please listen to his 1-minute commentary.
The Fed, like most major central banks, will wimp out, gonna blink, because the consequences of going back to 2% inflation will be economic and financial instability.
So basically, this is what Dr. Rubini is saying. Let's see, right now we are at 5%, 6% interest rates in the US. This will be cut and the stock markets are going to rally. And therefore, I am saying that in the long term, stock market is related to the economy, no doubt about that. But the short-term divergences will be varied and massive. Therefore, I choose to invest in the stock market even now, despite being pessimistic about the economy. So back to topic, that this interest rate will be cut. But will it go down to this level? The answer is no. It will not go down to this level, because the second bout of inflation can't be created in the economy. The first major bout of inflation happened somewhere in, let's say, 1970s. That is when massive problems started emerging in the economy. That was kind of a lost decade even for the US. Now, something similar is happening in the economy even now. Does it mean that we will again witness the same fate as 1970s? That remains to be seen. But Going forward, it is very, very likely that the interest rate will not get cut to 0%. It will move to maybe like 2 to 3% in the US. That means that there will be a lot of pain along the way. Now, how exactly will this translate into pain? Let me explain that by using the example of T-bill. Now, when Silicon Valley banks collapsed, what was the reason for that? Well, it was the nominal decline in the T-bill value. That's something that was considered to be 100 rupees worth, the T-bill. It lost its notional value to almost 70 rupees. There was a 30 rupee loss on a very, very safe asset. Why? It was because of interest rate changes. How exactly? That mechanics is complicated. So let's not get there. But this 30% erosion in T-bill value, why did that happen? It happened due to change in interest rate. Now, some similar type of resetting will happen in the world if the world moves to only 2 to 3% interest rate rather than the default rate interest of 0%. So this is where the world is likely to exist over the next 1 to 1.5 decades. So this brings me to the final section, that how do you relate all this economics to the stock market and investment? So there are few critical points. Point number one is that in the short run, the stock markets might very well rally. In fact, I am of the sentiment that the stock markets will rally. Number two, the economy is fundamentally weak and there is no easy path here. The governments all across the world, the central banks all across the world are trying their level best, but the situation seems to be going out of control. So this situation will be painful and the pain is already being exhibited, and it is very, very likely that whatever prices you see today, that dal price is roughly like 200 rupees, it will go to 300 rupees. Give it another 2 to 3 years and revisit this video. Number two, you have to be a diversified investor and avoid high leverage companies, because as the market moves to 2 to 3% interest rate repayment cycle, a lot of high debt companies are going to get wiped out or are going to perform really, really badly. So generally avoid high capital expenditure companies. This is what I tell my students also. In case you want to learn more about how I pick stocks, what exactly do I teach, you could consider joining our member community or my stock market course. The community access comes free with it. We are building India's biggest stock investment community, and I teach all fundamental technical analysis, macroeconomic analysis, so that you can learn to manage your own portfolio. So if you are interested, definitely do check us out. Third and finally, it makes a lot more sense right now to buy real assets. Now, it could be Bitcoin according to you, it could be real estate, it could be anything that has a limited supply. Finally, in conclusion, please understand the point that going forward, short-term debt is going to be much more lucrative than long-term debt. I'll probably make a separate video, but in case you are picking long-term debt instruments, kindly avoid doing that. Pick short-term debt instruments. That is much more useful. So I hope that this video helped you out. I know that this was a little bit complicated macroeconomic analysis, but these type of analysis is exactly what is going to help you out. So I hope that you enjoyed the video. If you did, do leave a comment and do press the like button, and I will see you soon.